Usually when we talk about traditional energy companies, specifically independent natural gas producers, there is a very specific, almost cinematic picture that comes to mind.
Oh, yeah. You picture wild swings in commodity prices, right?
Right, exactly. And massive crushing debt loads, plus this constant, almost desperate need to just drill more holes in the ground to keep the lights on.
Because historically, it was entirely a volume game. Energy producers treated the ground like an ATM,
Yeah.
just pulling out as much product as fast as humanly possible.
Yeah, and often at the direct expense of long-term profitability or, well, shareholder value.
Absolutely. It was growth for the sake of growth.
But what happens when an independent natural gas producer starts acting less like a traditional wildcatter and more like, I don't know, a highly disciplined cash-hoarding tech stock?
It definitely changes the whole narrative.
It really does. What happens when a company starts buying back its own shares at record speed, shrinking its debt to near zero, and quietly positioning itself to power the artificial intelligence revolution? Well, welcome to the deep dive. Today, we are looking right at you, our listener, because we are lifting the hood on a company that is actively rewriting the modern energy playbook.
We really are.
We've spent the week tearing through Gulfport Energy's Q1 2026 earnings report, their latest investor presentations, their Q1 press release, and the May 6th earnings call transcript.
And our mission today is to figure out exactly how this company is pulling off this pivot. We're going to examine the actual mechanics behind their ground-level operational efficiencies, their highly aggressive land acquisition strategy.
Which is wild, by the way.
It is. And how a totally unexpected tailwind from the massive build-out of AI data centers is coming together to turn Gulfport into an absolute cash flow machine.
Okay, let's unpack this. Because before we even talk about how they are pulling natural gas out of the ground,
Yeah.
we have to look at the staggering amount of money they are pulling into the bank.
The financials are, frankly, incredible.
They really are. And I want to point out a wild anomaly directly from the source data first. Gulfport reported an actual EPS, earnings per share, of $999.
Yeah, which is an apparent massive beat of $991.30 over expectations.
Right. And while that specific data point is a bit head-scratching, maybe a reporting quirk or an accounting thing, the other numbers are equally robust.
They absolutely are. We are looking at $437.53 million in total revenue.
Beating Wall Street's expectations by over $54 million.
Exactly. Plus, they generated $264 million in adjusted EBITDA and a massive $119 million in adjusted free cash flow just in those first 3 months.
Which is huge.
Generating $119 million in free cash flow in a single quarter is a massive achievement. But what is truly turning heads is what the management team is doing with that cash.
Right, they aren't doing what energy companies used to do.
No, they're not plowing it into vanity projects or recklessly expanding their footprint just to boast about production growth.
They are buying their own stock. I was reading through the earnings call transcript, and the way they describe this massive stock buyback program, well, the best analogy I can think of is a poker player.
Oh, I like that.
Right. Think of a poker player who has seen their cards, they know they have a winning hand, and they just go all in on themselves. Or like a highly successful local restaurant owner who gets a windfall of cash.
And the traditional impulse there is to open a second location.
Exactly. Take on more risk, hope it works out. But this owner realizes their current restaurant is so incredibly profitable and so deeply undervalued by the market that the absolute best investment they can make is simply using that cash to buy out their silent partners.
And they're doing it at scale. In Q1 alone, Gulfport repurchased 866,000 shares.
Wow.
Yeah, that is about $172.8 million spent buying their own stock in a single quarter.
That's a massive bet on themselves.
To put that in perspective, that is the highest quarterly investment in the company's entire history. Since this program started, they have spent roughly $1.1 billion returning capital to shareholders.
That is just a staggering number.
Over the last 2 quarters alone, they have retired nearly 10% of their outstanding shares.
Retiring 10% of a company in 6 months is an aggressive, incredibly confident move.
What's fascinating here is the underlying financial health that actually allows them to execute a move like that without, bankrupting the company.
Right, because usually this much spending means massive debt.
Exactly. But if we look at their balance sheet, their trailing 12-month net leverage exiting the quarter was just 0.9x.
Less than 1.
Less than 1. For anyone listening who remembers the shale boom of the 2010s, seeing an energy producer with less than 1 turn of leverage is virtually unheard of. Back then, companies were routinely running at 3, 4, or even 5 times leverage.
Just funding their drilling with massive piles of junk debt.
Yep. Gulfport has essentially zeroed out that risk.
And on top of that, the source documents show they're sitting on $872 million in liquidity following a recent borrowing base redetermination.
Which is a huge vote of confidence.
It really is. And for you listening, in the energy world, banks periodically recalculate or redetermine how much money a company can borrow based on the current market value of the gas they still have in the ground.
Right, the reserves.
Yeah. So the fact that their borrowing base remains nearly $1 billion is a massive signal from their lenders regarding the sheer value of Gulfport's unmined assets.
And the management team made it explicitly clear on the earnings call. They view their own stock as deeply undervalued.
So buying it back is just the smartest play.
Exactly. They are prioritizing returning capital to shareholders, maintaining strict financial discipline, and flat out rejecting the old model of growth for the sake of growth.
But having the financial flexibility to buy back $1 billion in stock doesn't just happen through clever spreadsheet math in a corporate office.
No, you have to execute in the field.
Right. It requires pulling cash out of the dirt faster and cheaper than the guy drilling next door. So let's look at exactly how they were doing that on the ground, specifically through they call their discretionary acreage program.
This is a really interesting strategy.
It is. I look at this program a lot like commercial real estate speculation. Imagine you notice a neighborhood is quietly about to get incredibly popular. Instead of bidding on the giant, expensive high-rise right in the middle of town, you quietly go around the edges.
Just buying up the adjacent lots?
Exactly. Buying up all the empty, adjacent dirt lots for pennies before the big developers even realize what is happening. Over the past 4 quarters, Gulfport spent $102 million on this program.
And that $102 million bought them more than 2 years of high-quality drilling inventory at a cost of just over $2 million per net location.
That seems really cheap for this industry.
It is. The CFO noted on the call that this price tag is significantly below the valuation metrics we are seeing from much larger, highly publicized transactions in the immediate area. They are finding absolute bargains.
But, land is only a bargain if you can actually extract the resources out of it efficiently. And the operational mechanics detailed in this Q1 report are wild. Let's look at the Utica Basin in Ohio.
The drilling speeds there are incredible.
Gulfport set a new company record for drilling a top hole in just 5.4 days.
And we should probably explain why that matters.
Yeah, go ahead.
So the top hole is the initial vertical section of the well, drilled straight down before the machinery curves to drill horizontally through the shale layer.
Right.
Drilling that vertical section faster isn't just about setting a speed record, it is about pure economics. The rigs used to drill these wells are rented by the day.
And they aren't cheap.
No, they cost tens of thousands of dollars every 24 hours. So by completing a top hole in 5.4 days, and averaging 5.9 days across an entire 4-well pad, they are shaving hundreds of hours off the rental fees.
And crew costs and fuel consumption.
Exactly. It's massive savings.
And it isn't just happening in Ohio. In their other major operating area, the SCOOP in Oklahoma, drilling is historically much more geologically challenging.
It's notoriously difficult rock.
Yeah. Yet on their recent Hero pad, they dropped cycle times from spud to rig release down to just 40 days per well.
Which is a huge drop.
For sure. With spud being the moment the drill bit first hits the dirt, and rig release being the moment the drilling rig packs up to move to the next site, their internal target for that process was 55 days.
So they beat their own expectations by more than 2 full weeks per well.
Yeah.
Slashing 15 days of overhead off a single well fundamentally changes the break-even economics of the entire pad.
But hold on, this brings up something I really want to challenge you on.
Okay, let's hear it.
I'm looking at these metrics. Gulfport is getting incredibly fast. They're sitting on an inventory of over 700 gross locations, which equals over 15 years of net drilling inventory.
A massive runway.
If you are that good at pulling gas out of the ground and you have that much land ready to go, why not flood the market? Why not capitalize on that speed, crank up production, and sell as much as possible right now?
Because flooding the market destroys the value of your own product.
How's...
Well, natural gas pricing is highly sensitive to supply. If Gulfport and its peers just start pumping max volume, the local price of gas plummets, meaning they spend more capital to pull the gas out just to sell it for less money.
Sure, I get the supply and demand curve. But if Gulfport's drilling costs are significantly lower than everyone else's because of these 40-day cycle times, couldn't they theoretically survive the price drop while starving out their less efficient competitors?
I mean, in theory, yes, but that is exactly the old 2014 shale boom mentality that destroyed billions of dollars in investor capital.
Oh, I see.
Gulfport's management is playing a much longer game here. They are intentionally keeping their production relatively flat, reaffirming their guidance of around 1.03 to 1.055 billion cubic feet equivalent per day.
Which is still a lot of gas.
Oh, yeah. To put that in perspective for you, 1.05 billion cubic feet is enough natural gas to power millions of homes daily. It is a massive amount of energy, but they are keeping that volume highly controlled.
Because they want to protect their margins.
Exactly. Their ultimate goal is maximizing free cash flow. By keeping production flat while relentlessly lowering the cost to drill each well, the profit margin on every single molecule of gas they sell gets wider.
Here's where it gets really interesting, because if you aren't significantly increasing the total volume of gas you produce, the only way to continue growing revenue is to change what you are extracting and who you are selling it to.
Which brings us to their pivot.
Yes, Gulfport is deliberately shifting its production mix. We think of them purely as a natural gas company, but by the second half of 2026, roughly two-thirds of their new turn-in lines, the newly completed wells, will have a significant liquids component.
Yeah, they're targeting a low teens percentage of their total production to be liquids by the end of the year.
Which is a big shift for them.
It is. We are talking about natural gas liquids or NGLs like propane, butane, and ethane, as well as crude oil.
And why the sudden focus on liquids?
Layering in these liquids provides a crucial economic hedge. See, dry natural gas prices are highly volatile. They depend on things like mild winter weather or local storage levels.
If it's a warm winter, gas prices drop.
Exactly. But oil and NGLs often trade on entirely different global macroeconomic dynamics. By intentionally drilling acreage that yields a wetter gas, they are diversifying their product offering.
So moving out their revenue streams.
Yep. And protecting that precious free cash flow from a sudden localized drop in dry gas prices.
So they are actively altering the chemistry of what they pull out of the ground. But the other side of the equation is changing who they are selling the energy to. And this was honestly the most compelling part of the earnings call transcript.
If we connect this to the bigger picture, we have to look at the massive macroeconomic shift that management is openly targeting. Artificial intelligence and the explosion of data centers.
We usually talk about AI as a software story, neural networks, algorithms, code.
Right, but AI runs on physical hardware.
Exactly, and training those models requires an absolutely unbelievable amount of raw electricity.
Especially in the Northeast United States, which is right in Gulfport's operational backyard. The demand for power to run these hyperscale AI data centers is expected to radically increase over the next decade.
And there's a huge bottleneck there, right?
A critical one. These data centers require reliable 247 baseload power. You cannot turn off the servers simply because the wind stops blowing or the sun goes down.
And the current power grid completely struggles to provide that kind of unyielding reliability at a massive scale using only renewable sources. I mean, wind and solar are inherently intermittent.
And while nuclear power is fantastic for baseload, it takes 10 to 15 years and billions of dollars to permit and build a single new reactor.
Which leaves natural gas as the vital bridge.
Exactly. It is the only immediate scalable solution to provide the massive, consistent power generation these AI data centers require today.
So management is seeing this demand coming.
Oh, Gulfport's management is openly bullish on the long-term price of natural gas because they are sitting on decades of high-quality inventory right as local power demand is poised to completely skyrocket.
And even if local data center demand takes time to build, the sources highlight that Gulfport has a highly advantaged firm transportation portfolio.
Meaning they aren't stuck.
Right. They aren't physically trapped, selling their gas only in the Northeast. They own guaranteed pipeline access to the Midwest, and more importantly, they have firm takeaway capacity running all the way down to the Gulf Coast.
That Gulf Coast access is vital.
Why is that so important?
Because it connects them directly to liquefied natural gas or LNG export terminals. It gives them the ultimate optionality.
Oh, I see.
Yeah, they can sell their gas locally to power a new Amazon data center, or if global prices spike, they can pipe it south, liquefy it, and sell it to the global market. They are structurally positioned to capture favorable tailwinds regardless of where they originate.
But navigating a pivot of this magnitude, balancing $1 billion share buyback, Scaling a new liquids portfolio and capitalizing on the AI power grid, that requires incredibly sharp leadership.
It's a lot of moving parts.
It is, because the last thing a company needs when negotiating to supply power to a major tech conglomerate is to trip over local regulatory hurdles or suffer a massive operational failure.
Well, the earnings report actually included a major leadership announcement to address exactly that. Gulfport introduced their new CEO, Domenic J. Dell'Osso Jr., taking the reins on May 28, 2026.
Okay, so a new captain at the helm.
Yeah, and the CFO made a distinct point to highlight why the board chose him. Dell'Osso brings over 2 decades of energy industry experience, but his hallmark is a strict, unyielding focus on operational and financial discipline.
So he's not a drill baby drill kind of guy.
He is explicitly not a growth-at-all-costs executive. He is exactly the profile of leader required to maintain the complex free cash flow machine we have been dissecting.
And he is stepping into a company that isn't just financially clean, it is operationally spotless. I want to look at Gulfport's ESG scorecard real quick. Environmental, social, and governance.
A lot of people dismiss ESG.
They do. A lot of times in the corporate world, ESG reports can feel like glossy fluff, just marketing brochures to appease certain investment funds. But when you look at Gulfport's numbers, their ESG metrics are just pure operational excellence. It is entirely about risk mitigation.
Because if you have a blowout or a major spill, you aren't just paying a fine to the EPA anymore. You are potentially losing a massive multi-year contract with a cloud computing provider who has strictly enforced green energy mandates for their supply chain.
Exactly the stakes they are playing for. And they are executing flawlessly. In Q1, during their highest period of drilling activity, they recorded 0 safety incidents, 0 spills.
Wow.
Yeah. Year over year, they saw a 44% drop in total safety incidents across the company. That means the machinery is running safely, the crews are focused, and downtime is minimized.
And environmentally, the mechanics of their progress are equally impressive. They lowered their Scope 1 methane intensity by 20% year over year.
It's a massive drop.
It is. And if you look back just to 2022, they have reduced methane intensity by an incredible 33%.
Which begs the question, how do you radically drop your emissions while actively drilling faster and more efficiently?
It comes down to fundamentally upgrading the mechanics of the oil field.
Like new tech.
Sort of.
Mm-hmm.
Historically, traditional oil field equipment used the pressure of the natural gas itself to open and close pneumatic valves, which meant venting a tiny bit of raw methane into the atmosphere every single time a valve actuated.
Oh, wow. I didn't know that.
Yeah, it adds up. The investor presentation notes that Gulfport actively invested capital to eliminate these natural gas-driven pneumatic devices, replacing them with systems driven by compressed air or electricity.
That makes total sense.
They also implemented advanced leak detection programs and continuous methane monitoring technologies.
See, this isn't just about being environmentally friendly for a press release. It is about not wasting the actual product you're trying to sell. Every molecule of methane vented into the air is a molecule you can't put in a pipeline and sell.
Exactly. And it is paying massive commercial dividends, too. They secured an A rating from MEQ, which is an independent, highly rigorous methane emissions certification standard for their Appalachia assets for the 3rd consecutive year.
3rd year in a row. Nice.
Yeah. When you are sitting at the negotiating table trying to sell natural gas to power a massive data center for a hyperscaler like Google or Microsoft, having an independently certified low-emission product is a tremendous competitive moat.
So what does this all mean? If we step back and synthesize this entire Q1 2026 stack, the earnings beat, the call transcript, the strategy presentations, Gulfport Energy is putting on a masterclass in modern corporate discipline.
They really are.
They are quietly buying up undervalued dirt. They have engineered ways to drill that dirt faster and safer than they ever have in their history. And instead of wasting those profits on vanity expansions, they are relentlessly returning that cash directly to their shareholders.
And they're doing all of this while intentionally shifting their product mix to perfectly position their natural gas to serve as the unyielding power source for the next generation of artificial intelligence.
It is a phenomenal evolution.
Mm-hmm.
They have entirely shed the chaotic boom and bust image of the past decade. It is a calculated, highly calibrated operation.
It really is.
Which leaves us with a final thought for you to mull over as you go about your day. We are constantly inundated with headlines about tech giants investing tens of billions of dollars in new AI chips, massive server farms, and sprawling cloud infrastructure.
It's all anyone talks about.
Right. But given the absolutely staggering amount of reliable 247 power required to run these supercomputers, how long will it be before companies like Amazon, Google, or Microsoft stop simply buying power off the local grid and decide to start directly acquiring highly disciplined natural gas producers like Gulfport to secure their own private, uninterrupted energy supply?
When energy becomes the ultimate bottleneck for computing power, the definition of a tech company's supply chain is going to change very quickly.
It completely reframes how we should be looking at the value of traditional energy in a world dominated by AI. It really
Yeah.
does. Thanks for joining us on this deep dive.